This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, Australia's first and only dedicated currency program. The local currency rallied back to within a whisker of 73 cents last Friday after the US Fed decided to leave its ultra-low interest rate on hold. But come Monday, commodity prices started to tumble on the back of concerns global growth is slowing more than economists forecast. But fast forward to Wednesday this week, and the Aussie dollar was back under 70 cents and had erased all of the previous week's gains after China's latest manufacturing figures showed the weakest PMI reading in 6.5 years. So what does the falling economic sentiment mean for currency markets? Joining me shortly from Singapore to discuss how currencies are moving is Annette Beacher from investment bank TD Securities. We'll also cross to our Sydney CBD studio to chat with David Green from AFEX about his thoughts on where to next for the Aussie and Kiwi dollar. Plus, I'll share with you my big currency movers, as well as give you a chance to win $500 cash with our weekly currency quiz. Plus, we'll be answering your currency questions live on the show. You can email me directly right now via andrew@moneyexchangetv.com. Let's kick things off by first taking a look at this week's headlines. Federal Reserve Chair Janet Yellen has laid out her most detailed case yet for the central bank to begin raising short-term interest rates later this year. Speaking at the University of Massachusetts in her first address since the decision to keep rates near zero last week, Ms Yellen said headwinds to growth are expected to fade, boosting the underlying strength of the US economy.
Most of my colleagues and I anticipate that it will likely be appropriate to raise the target range for the federal funds rate sometime later this year and to continue boosting short-term rates at a gradual pace thereafter as the labor market improves further and inflation moves back to our 2% objective.
The Fed chair said US policymakers will continue to monitor weaker activity overseas, but the impact will not be large enough to affect interest rate policy. And at home, a senior Treasury official has confirmed the Turnbull government is looking at superannuation tax concessions. Paul Tilley is head of the Personal and Retirement Income Division. He told a parliamentary inquiry into home ownership that Treasury had spent a lot of time considering capital gains tax exemptions on investment properties. He also says the new Prime Minister and his Treasurer will have indicated they will examine the areas of superannuation. The coalition under Tony Abbott ruled out adverse changes to superannuation in this term or next. My first guest on the program tonight is joining us from Singapore and is Head of Research and Securities at TD Securities, Annette Beacher. Annette, welcome to the program. Thanks for your time this afternoon and this evening here in Australia. We saw China's PMI data, a 6.5-year low. Interesting, every time you and I talk on the program, the Aussie dollar ends up breaking under 70 cents. I think that's something the viewers should take note of, do you think?
Well, I think so. There's always plenty of opportunities to take a position on the exchange rate, but unfortunately, the econometrician in me says sample size of 3, maybe not quite enough to put your hard-earned on it yet, but something we can keep an eye on going forward. But Aussie, yes, this time last week we were waiting for Ms Janet Yellen to maybe hike interest rates. They didn't. And instead we got a reality check that the FOMC was a little bit worried about global growth and volatility. And of course, 3 or 4 days later, we get that terrible 47 PMI. Now, personally, I think this number is absolute rubbish. It doesn't tell us anything about the whole economy. It tells us about manufacturing, which has actually been shrinking for about half a decade now. So it's telling us really what we already know. But it's very tradable and it's very sensitive for currency markets. So whether I trust the number or not is irrelevant. It really did get that Aussie back under 70 cents.
So, Annette, with the China economy obviously slowing over the last year or two and the expectations in the future, what's the chances, do you think, of the People's Bank of China injecting a stimulus of some kind to try to break that sort of cycle of negative growth?
I think we probably need to have two different discussions. We are certainly overly focused on manufacturing, which is embodied in industrial production and these PMI numbers every month, or actually 3 times a month if you count all the PMIs. When in fact, you know, the first half of this year, yes, GDP was at 7%, but 60% of that growth was actually consumption. So maybe if the government's looking to cushion the economy, perhaps we're probably better off talking about services and households rather than pouring money into what is increasingly a shrinking industry.
So what about the emerging markets at the moment, Annette? We're seeing a lot of concern around global growth. How much of that concern around that global growth is really centred on the emerging market economies at the moment?
Unfortunately, very much so. As we know, the global financial crisis was pretty much a Western problem, starting with the US and quickly the contagion into all other Western economies. But I guess lucky for the world and Australia in particular, that's when China really decided to ramp up growth, really overstimulated the economy and in fact stopped the whole world going into recession. And so here we are sort of 7 or 8 years later. I think it's time for China to pull back. And mind you, pulling back is 5–6% growth. In contrast, we've got the US that was struggling for quite some time, now expected to grow at about 2.5%. Japan's scraping together at 1%, and even Europe's contributing at 2%. So I think we're just seeing what is a big set cycle rotation, where we had the Western economies in recession, we had Asia doing quite well, and now we're seeing a bit of a turnaround on that. And so that's what big investment cycles are about, is capturing who's going to be the growth leader, and I think this time around it might actually be more the Western economies.
And Annette, just very quickly, are we still looking at a 68-cent price target for TD Securities between now and Christmas?
Absolutely, unless it's 70 cents each time we meet, and then we might have to have a different forecast. But at the moment, we do agree with Janet Yellen. There is a very strong possibility we see higher US interest rates by year end. I mean, we're talking tiny numbers here, but it's not about the first hike, it's about what happens after that. So we do see a bit more pickup in the US dollar, and that's the only reason why I've got Aussie trading below 70 cents. I'm certainly not going down the path of Australia into recession. In some ways, I do welcome a new government and new cabinet. I do think optimism has been very much missing in the Australian economy, and I think we do need a little bit more than that.
Annette, as always, thanks so much for your time. After the break, we'll cross to our Sydney City studio to chat with senior currency dealer at AFEX, David Green, about where he thinks the Aussie and Kiwi dollars are headed next.